Every time you get paid, send money, or invest even a little, you assume the IRS only knows what you choose to report. But by the time you file your tax return, the IRS often already has its own version of your financial life. Your tax return isn't revealing new information, it's confirming what their system already knows. I didn't fully understand this early in my financial journey. As my income grew from my career, investments, and eventually real estate, I started realizing that the financial system itself was quietly reporting pieces of my activity automatically. Not because anyone was watching me personally, but because that's how modern financial infrastructure works. Once I understood it, it completely changed how I approached money. I became more organized, more intentional, and far more aware how financial systems actually operate. In this video, I'm going to show you the exact ways the IRS already knows what you're earning, including how your paycheck, payment apps like Venmo and Cash App, crypto transactions, and even automated data systems quietly report financial activity behind the scenes. And one of these methods catches people completely off guard, especially those with side income or investments. So make sure you stay till the end, because understanding this could save you from a costly mistake later on. My goal here isn't to create fear, it's to give you clarity, because when you understand how the system works, you can operate inside it confidently. And if you're getting any value from this video, hit the like button. It helps more people understand how money actually works. The first and most fundamental way the IRS knows what you're earning is through your employer. Every time you receive a paycheck, your employer sends information to two places. They send it to you and they send it to the IRS. This happens through forms like W-2s for employees and 1099s for contractors. So by the time you sit down to file your taxes, the IRS already has a record of what you are paid. Their system automatically compares what your employer reported with what you reported. If the numbers match, everything moves forward quietly. But if the numbers don't match, that's when notices get triggered. Not because someone singled you out, but because the system detected a discrepancy. Most tax issues don't start with audits, they start with mismatches. That's the mechanism, and it's completely automated. Another major way the IRS knows what you're earning is through third party payment apps. PayPal, Venmo, Cash App, these platforms have become incredibly common, especially for side hustles, freelance work, or selling items online. And here's a part what many people don't realize. These platforms are required to report certain transactions to the IRS, which means incomes received through these apps become part of your financial record. I've seen this happen with people who start small. They sell items online, do a few freelance projects, accept payments casually. It doesn't feel like formal income. It feels informal, temporary, almost invisible. But from the system's perspective, it's not invisible. It's recorded. And once it's recorded, it can be matched against your tax return. This is one of the most common ways people accidentally create problems for themselves, not because they intended to do anything wrong, but because they didn't realize that the income is already being reported. The system sees the pattern, even when you don't. Another way the IRS knows what you're earning and investing is through cryptocurrency exchanges. There was a time when many people assumed crypto operated outside traditional reporting systems. That assumption doesn't hold anymore. Cryptocurrency is treated as property for tax purposes, and many exchanges already report transaction data directly to the IRS. This includes when you buy crypto, sell crypto, or trade one cryptocurrency for another. Each one of these actions can create a taxable event. And starting back in 2025, tracking has become even more precise. Instead of viewing your crypto holdings as one pooled balance, reporting now tracks cost basis wallet by wallet, which makes it easier to match exchange data with what you report. This doesn't make crypto bad. It just means record keeping matters because the visibility already exists. Another way the IRS knows about your financial activity is through foreign financial institutions. If you hold accounts outside the United States, those institutions may still report information tied to US citizens. This happens under a law which requires many foreign banks and investment platforms to share account information with US authorities. The goal is simple: to prevent income from being hidden offshore. Most people watching this won't have foreign accounts, but the principle matters. Financial reporting doesn't stop at borders, it flows across systems. Another powerful way the IRS knows what's happening financially is through automated data analysts. This is where technology has changed things dramatically. The IRS uses machine learning systems that analyze massive amounts of financial data. They're not manually reviewing millions of individuals, they're scanning for patterns. For example, if someone reports very low income, but other data sources show financial activity that suggests higher earnings, that discrepancy creates visibility. It doesn't mean something is automatically wrong, but it raises questions because the system is designed to identify inconsistencies between reported income and observed financial behavior. Most enforcement doesn't begin with people, it begins with patterns and patterns that don't align. There's also one more way the IRS learns about financial activity that surprises most people: tax fraud tip systems. Individuals can report suspected tax noncompliance, and in some cases, whistleblowers can receive financial rewards if their information leads to recovered taxes. This isn't the primary way enforcement happens, but it reinforces something important. Financial systems don't exist in isolation, they exist within networks of reporting, and transparency protects you. Now, here's what most people miss: the IRS doesn't need to guess what you're earning, it receives information automatically from employers, payment platforms, exchanges, and financial institutions. Your tax return isn't the starting point, it's the confirmation point. That shift in perspective changes how you operate. You become more organized, you keep better records, you operate with intention, not fear, but structure. Because wealth isn't just about earning money, it's about protecting what you build. And structure is what protects it. The people who run into the most trouble usually aren't trying to break the rules. They're disorganized. They forget about side income. They assume small amounts don't matter. They lose track of transactions. But systems don't operate on assumptions, they operate on data. And when your records align with the data already being reported, your financial life becomes smoother, quieter, and more stable. If there's one takeaway from this video, it's this: the IRS already has visibility into many parts of your financial life. Your job isn't to worry about that. Your job is to stay organized, accurate, and intentional with your financial records because clarity protects you. It protects your wealth. It protects your peace of mind and allows you to focus on building your future instead of fixing preventable problems. So, if you got any value from this video, hit the like button. Subscribe if you want to build wealth while avoiding costly mistakes. And tell me in the comments down below what's one of the types of incomes you've earned outside of your main job: a side hustle, investments, selling items, anything. I read every comment, and it helps me create videos that are relevant to you. Once again, thank you for your time. I'll see you in the next video.